valuations have been quite attractive, both on the continent and in the UK. The investing opportunity is quite different outside the United States. Valuations look much more normal or even depressed in markets as opposed to being elevated in the US.
First Eagle Global Fund's Matthew McLennan is on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. If the world is your portfolio focus, you have your hands full. There's increasing geopolitical risk. War has broken out all over Ukraine and Russia, the Israelis, Hamas, and Hezbollah, the rebels in Syria, not to mention ongoing conflicts in other parts of the world. Tensions are also high in Asia between China and its neighbors, especially Taiwan. North Korea is perpetually belligerent and has joined forces with Iran, Russia, and China to challenge and destabilize the West and democracies in general. And speaking of the same, several normally stable democracies are seeing their governments under pressure. France's prime minister was forced out, the first time that has happened in decades. Germany's government is divided and fractured, and South Korea's president momentarily declared martial law. In contrast, despite a divisive election, the U.S. looks like an oasis of common prosperity. U.S. stock market capitalization has expanded to 75% of the entire world stock market value. According to Rosenberg Research, that is a record by any stretch. It was below 60% in both the Nifty 50 bubble of the 1970s and the tech bubble of the 1990s. This chart from Rosenberg Research illustrates the story. It shows the relative share performance of the S&P 500 to the rest of the world since the global financial crisis. The U.S. has been the place to be. But is it, and for how long? Joining us is Matthew McLennan, a seasoned global investor with an outstanding track record, who oversees over $100 billion in assets for First Eagle Investments. McLennan is co-head of the firm's global value team and co-portfolio manager of its flagship First Eagle Global Fund, which he has run since 2008. The Global Value Fund is ranked in the top decile of global allocation funds ranked by Morningstar for the last 10, 5, and 3-year periods and carries the firm's 5-star and silver analyst rating. First Eagle is a Wealth Track sponsor. McLennan's track record speaks for itself. I asked McLennan to assess the state of the world from a global investor's perspective. What does it look like?
When I'm putting my investment hat on, the way I look at the world is that the markets globally are not pricing the risks symmetrically. What do I mean by that? I think when you look at the biggest economies in the world, the US economy and the Chinese economy, they're behaving very differently, and the markets are behaving very differently. So for much of the decade after the global financial crisis, you saw the Chinese and the US stock markets going up and down together, Chinese and US bond markets going up and down together. But the last few years, they've really decoupled. And so on the one hand, we have the US market, which everyone's familiar with, making new highs. We have interest rates in the US, even though they've tapered off a little bit in the last year, breaking out on the upside from a 40-year downtrend. We have low risk perception in the US. Credit spreads are tight. Trading breadth is good in the markets. Implied volatility is low. On the other hand, in China, we have interest rates breaking out on the downside. The Chinese stock market is down about 50% from its peak in the last couple of years, and risk appetite is quite suppressed. And so you have these two very different spheres of activity in the world. And what that tells me as an investor is that diversification is ever more important today because the correlation has broken down between markets. And valuations outside the United States are so much cheaper than they are inside the United States.
Why is the U.S. doing so much better than China, than the Eurozone, for instance, than the rest of the world? What is our secret sauce?
On the one hand, there's things about the US economy that render it to be quite resilient. You have very vibrant educational system, very vibrant tech sector, quite flexible labor markets. Those are all reasons why the US has done somewhat better than the rest of the world, but they're not fully explaining the differences. In truth, part of the reason the US has done better is that we've had a great deal of fiscal stimulus, even though we don't have a recession.
What about the other democracies in Japan and the Eurozone, for instance, which are growing much slower than the US is? What's the difference there?
So in part, you've had less fiscal stimulus in these regions. You still have pretty easy fiscal policy. I don't want to get that wrong, but it hasn't been as extreme as the United States. I think the other thing is that you've just had more subdued animal spirits. In the case of Europe, you've been literally adjoining a war zone, and that's had implications for the industrial sector, local energy prices there, and the competitiveness of that local manufacturing complex, particularly in Germany. And that's been weighing on sentiment. And you have quite a bit of political uncertainty in Europe, which I think is sort of weighing on the animal spirits. And at the same time, you haven't had this AI boom that we've seen in the United States. If you think about it, think of the big investors in AI equipment, the Microsofts, the Amazons, the Googles, and these and the Metas of the world, Facebook. These companies each individually are spending more than ExxonMobil on capital expenditures. You don't have that similar capex boom going on in Europe.
75% of the world's market capitalization is the US market. And I was reading some research recently that even at the height of the tech bubble and the Nifty 50 bubble, it was under 60%. So our stock market has just exploded on the upside. And that is a phenomenon that you have been watching and remarking upon for several years. Talk about complacency being kind of baked into the US stock market, but it keeps going up.
Therein lies the problem for investors, because it's one thing to say that the US economy has been doing better than, say, Europe or parts of Asia or Latin America. But on the other hand, it's not going to help you as an investor if that's already being well and truly priced into the market. And to give you a sense of that, the PE ratio on the S&P 500, the price to earnings ratio, is about 22, 23 times expected earnings. That's about a 4.5% earnings yield. The same numbers outside the US, if we look at all stocks around the world, north of 7%. So while there's been malaise in Europe, there's been challenges in Asia, the difference in the growth rate of productivity between these parts of the world is barely more than 1%. Yet investors are demanding 3% or so lower yields for US equities. And so you could make the argument that even though prospects have been better in the US and maybe better, it could be more than fully priced in markets right now.
I mentioned earlier about all of the unsettled state of the geopolitical situation. Are there any other periods in history that remind you of the state of the world now and that guide you as an investor?
I think when you look back at history and you look at other periods where conflict has globalized or political extremism has globalized, one of the lessons, at least I get from that, is that the system itself becomes less predictable, not more predictable. You get fatter tails in terms of the possible distribution of outcomes. And so one of the lessons that we've sort of taken to heart from reading history is that you should go into a period like this where there are forces at work, prepared for some degree of uncertainty that's very different from our statistical sense of risk. We could look back at World War II, World War I, other periods like that, or smaller conflicts that are regional in nature. But I guess the one that I keep coming back to in my thoughts is the Peloponnesian War back before 400 BC that was written about first by Thucydides and more recently by other authors such as Victor Davis Hanson. And he wrote a great book on this called A War Like No Other. And I think it has interesting parallels because at the time, Athens was a very vibrant liberal democracy. It had more gold, more wealth, better fortifications than its surrounding neighbors. Sparta, on the other hand, was more of an authoritarian structure, more of a militaristic structure, and it was poorer. Yet Sparta ended up prevailing in that conflict through a series of regional alliances. And the Athenians failed by virtue of hubris in the fog of war. And so I think there are lessons to be learned. One shouldn't be complacent when there are these kind of forces at work. And I guess that's the one conflict that I spend most time thinking about. And I think it brings me back to the notion that diversification is important. And having some ballast in the portfolio is important.
We've talked many times before, but about the importance of the ballast of gold being a ballast in the portfolio, and the position that you've held in gold over the years has really set you apart from your global allocation peers. Give us an update once again on the role that it's playing, Matt.
So if you're trying to construct a more balanced or a global allocation portfolio, you're typically going to look for some form of ballast in the portfolio. And I think the gold has helped distinguish us from some peers who have been more reliant on fixed income as a potential hedge in their portfolios. And if you think about the fiscal issues that I've talked about globally, one of the problems when you have large and recurring fiscal deficits is that often the supply of government debt grows faster than the yield on that government debt. And then interest rates can drift higher, and then that pushes deficits up further, and you have this negative effect that goes on that impairs the purchasing power of traditional fixed income. Gold, on the other hand, is a real asset. It's relatively fixed in its supply character. And so if the nominal value of the economy is drifting higher by virtue of this easy fiscal policy, gold's value tends to drift higher with that. You had an asset that has a naturally defensive character. The best decades for gold have tended to be the worst decades for equities. Mm-hmm. But it's also been an asset that's compensated you for the rate of nominal growth in the economy, whereas traditional fixed income hasn't. And I think that role for gold still remains today. I would say that we've been prudent in our portfolios, when in periods when gold has done very well, to trim a little here and there so that it doesn't become an outsized position in our portfolio. But still, we have a mid-teens percentage of our portfolio invested in a combination of gold bullion, gold miners, and royalty companies.
And how unusual is it that we've just gone through a period, we're going through a period where gold and the stock market have appreciated both considerably at the same time?
It is unusual, and
Yeah.
I think you can take something from that. Equities are a claim on real assets. Gold is a real asset. Gold is defensive. Equity is, pro-risk, if you will. The fact that they've both gone up together tells me, at least, that the real value of our money has gone down. And that is a function of this very easy fiscal policy that I've been talking about. And so I think it's a warning sign as to the quality of our monetary architecture. And it's not a US-centric phenomenon, it's happening everywhere. And so I think that's really the message that one should take from both assets having performed reasonably well. It's just that money is going down.
Looking around the world, and at the outset of this discussion, you mentioned the fact that if you compare the valuations in the US stock market versus the valuations in other markets, that there's a huge difference, and in fact that the better values, you're a value investor, can be found internationally. So where are you finding compelling values in other markets and in the securities in them?
I would say that in markets throughout Southeast Asia, markets like Korea, for example, Japan, we've seen quite undemanding valuations. Latin American valuations, very undemanding. And as you mentioned before, Europe has been going through some malaise. And so valuations have been quite attractive, both on the continent and in the UK. And so really the investing opportunity is quite different outside the United States. Valuations look much more normal or even depressed in markets as opposed to being elevated in the US. And so what that means to us at a micro level is if we're going to invest in a US security, we want to find a business that's out of sync with the enthusiasm that's going on at the margin. If we're investing globally, we can find perhaps very high quality businesses at reasonable prices. And so it influences the kinds of businesses we might look for.
So what's out of sync with the bull market in the US?
The world of the US investor has been very centered around AI. And mind you, we have a number of investments in our portfolio that have benefited from the AI-related developments in the United States. And so we haven't avoided that. We've been able to participate in a measured way. But one area that's been out of favor is medical technology. And there's some great businesses there that trade very reasonable valuations. And to give you an example of our largest holding in medical technology, a company that many of your audience have probably heard of is Medtronic, which is it's a leader in areas as varied from pacemakers to neural and spinal implants, surgical equipment. And it's truly a wonderful business because you are an embedded part of an ecosystem where you've invested a huge amount of R&D behind these product lines. The practicing surgeons habituate on these products, and you have a kind of regenerative feedback process where your sales force is embedded with the customers and your R&D teams to keep improving these. So it's a very durable business. And because the whole medical equipment space has been out of favor, it trades at a quite undemanding valuation. You have about a 6% free cash flow yield. In fact, the combination of the dividend yield and the share repurchase exceeds 7% of the current market value. Now, I remember a time back in the late 1990s where this stock traded at a huge valuation.
Any other kind of undervalued segments and companies in the U.S. market that might surprise us, or that you found that have not been discovered by other investors?
Sometimes you have to go very idiosyncratic. And so one of the areas that you and I have spoken about over the years has been our enthusiasm for factory automation companies. Because ultimately, the factory of the future will be an automated factory, and you want the equipment makers for that particular development. And I think that becomes even more important because if we're getting into a contested trade situation, tariffs, and the re-domiciling of industrial capacity, if we're going to rebuild industrial capacity in certain markets, it's going to require the latest equipment. And so one of the companies that we have an investment in is a company called IPG Photonics, which is the world leader in fiber lasers. They have over 50% share of the high end of the fiber laser market. And a fiber laser is a really important part of an automated factory, whether it's cutting, welding, and the end market applications are expanding for this. This company's been incredibly out of favor because they had, as you can imagine, a big business in China, which has been under pressure. And they had part of their manufacturing in Russia, which they've had to relocate.
Right.
Yet they're a necessary ingredient of the factory floor for tomorrow. And meanwhile, the stock has really been weak the last few years.
Let's look overseas, which you do on a daily basis. What are the other kind of idiosyncratic types of investments that you have been investing in for many years, but that look particularly undervalued now, given what's happened in the overall markets, international markets?
So maybe I can give you an example of one that's somewhat undervalued, but maybe a lot safer than you would think, and then one that is quite undervalued. And the former situation, and I raise it out of interest because when people think about Europe, they think about the malaise that you referenced before, and they say, why would I invest in Europe when it's, the economic story is not so good? But there are many companies listed in Europe that are truly global in nature. And one of them is a company called Haleon that was spun out of Glaxo. And Haleon is the world leader in over-the-counter medication. And they have a portfolio of iconic brands. They have Advil, the painkiller that you'd be aware of, all the way through to things like Robitussin and Tums. They also have some rapid growing product lines like the Sensodyne toothpaste business, and we love the toothpaste business. This is a really solid, well-managed company that over the long term can grow at a healthy clip and trades at a sound valuation because it's listed in the UK. Now, if you're willing to entertain the notion of going into markets that are not developing in nature, you can find businesses at quite undemanding valuations. And an example of that might be a company called FEMSA, for example. It's a Mexican listed holding company. And at First Eagle, we love investing in holding companies.
Explain why, Matt, because for those of our audience who are not aware of why holding companies are attractive to you, whereas they certainly are not attractive to a lot of other investors.
Well, the beauty of a holding company is that often it will trade at a discount to the sum of the value of the investments that it owns. And so if you like the investments they own, and those investments are not demandingly valued, and the holding company trades at a discount, then you get a double discount. And for us, that's important because it's a margin of safety. It comes back to what I said before about being a prudent fiduciary and wanting to preserve capital. And FEMSA is a good example of that because they have two really unique business units. They are a control shareholder in Coca-Cola FEMSA, which is the largest Coca-Cola bottler in Latin America. And it's Coca-Cola bottler is almost a misstatement now. They really have a very broad suite of beverages, and they have an unparalleled distribution reach, and it's a very stable business where private market valuations are quite high. They also have ownership of the OXXO convenience stores in Mexico. There's over 24,000 OXXO stores. It's virtually impossible to replicate convenience store network throughout Mexico. And when you look at that company together, overall, it's only trading at around about a 7 multiple of their EBITDA. Very attractive situation where they're returning to you north of 5% of the market value in combination of dividends and stock repurchase. There's a company that is run for the long term, that has very defensive businesses, but happens to be based in Latin America.
You mentioned China at the beginning of our conversation. China is a very high risk market. You mentioned that there were investments that you were involved with that benefited from businesses in China, but were not directly, Chinese owned or whatever.
To give you an example of the largest investment that we have that's in some ways a beneficiary of the valuation dynamic in China, we actually have an investment in a Dutch listed holding company called Prosus. Prosus is a fascinating company because it in turn owns 25% of the Chinese software giant, the online giant Tencent. Tencent's truly an incredible business. I mean, they are not just the leading gaming company, but they're the leading social media company and a leading payments platform in China, and they have a venture portfolio as well. But the beauty of owning that stake through Prosus is that the holding company trades at a 30% plus discount to the value of what it holds in Tencent and its other investments. And by the way, its other investments happen to be interesting. It is the leading online food distributor in Brazil. It has the leading online classifieds business, OLX, in Eastern Europe, and it has a leading payments online payments business, PayU, in India.
And actually, Prosus was your one investment recommendation a year ago, and it's done incredibly well.
I think if I could leave you with one idea, I'd leave you with that one again, because and I guess it comes back to our long-term holding period. Maybe we're 1 year into a long-term journey here. If you're going to make an investment like Prosus, you have to think about it in a portfolio context. And against the risk that we talked about, the China risk that's hard to quantify, you have to realize that on the one hand, we might have certain investments like Prosus. On the other hand, we have our stake in gold. So if there were some geopolitical conflagration that was very negative for those securities, it may be positive for gold. And so we look for that kind of balance between scarce assets in our portfolio. And the other thing I'll mention is that many of the darling stocks in America that we don't own, the Nvidias, the Apples of the world, are totally dependent on China and Taiwan for their supply chains. It's interesting to me that risk, that China discount, is being better priced in securities like Prosus than it is in companies like Apple and Nvidia that depend on that region of the world for their key inputs.
Matt McLennan, always a treat to have you on Wealth Track. Thanks so much for joining us again this year.
Thank you so much. It's great to see you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is one of my perennial New Year's resolutions. It is read some inspiring biographies in the year ahead. My choice this year is The Troublemaker: How Jimmy Lai Became a Billionaire, Hong Kong's Greatest Dissident, and China's Most Feared Critic by Mark Clifford. It is the story of the life of one of my heroes whom I met very briefly several years ago before he was imprisoned in Hong Kong for sedition, i.e. speaking out in favor of freedom and democracy and against repression and tyranny. In a free, law-abiding, non-authoritarian country, Jimmy Lai would be lauded, not persecuted. Instead, he has been in prison for nearly 4 years, much of it in solitary confinement. As the Wall Street Journal's reviewer put it, Mark Clifford's book is a sympathetic and inspiring biography of a Chinese patriot and militant anti-communist with a libertarian's robust belief in open markets and limited government. Prison was the only way this irrepressible, no magnificently stubborn man could be silenced. When you read The Troublemaker, you will hear Jimmy Lai's voice loud and clear. Next week, Jason Zweig, the editor of the 75th anniversary edition of The Intelligent Investor, Benjamin Graham's classic, joins us to share what Warren Buffett calls by far the best book on investing ever written. In this week's extra feature, Matt McLennan shares his reading recommendations for the holidays and beyond. Please follow us on Facebook, X, and our YouTube channel. Thank you for watching. Have a joyous Christmas season and make the week ahead a healthy, profitable, and productive one.